Good morning, everyone. I hope you had another fabulous evening, catching up with old friends, networking, making newer friends. And what better way to start the grand finale or the final day of the GCA than, discussing things with the regulator. And I know Arora ji for many, many years, actually, Both of us almost started our careers in Life Insurance Corporation at the same time. We were the same batch in the organization. I think the challenges for a regulator is to be able to balance the needs of various stakeholders. You're talking about policyholders, you're talking about shareholders, you are talking about the insurance companies. So the balancing act gets very, very challenging for them because, you have to ensure transparency, fairness, and stability of the sector as a whole. And if you top it up with development, so you're not just talking about regulation, you're talking about development, and with Amrit Kal being announced by the policymakers, the role of the regulator becomes paramount. As I said, I know Arora ji for many, many years, and I know the passion that he has in the industry. When we were actually, undergoing training in the same training center in LIC, he used to stand out from amongst all of us in terms of trying to get into the depth of the why. It's not just the what and how, but it is the why that he used to get into depths in. And I see that passion continuing as he's a part of the regulatory body. And, I think there's a lot of, and I can sort of take the liberty of saying that the regulator is on steroids these days, right? So there's a lot that they are doing, rightfully so, because it's the need of the hour. We're talking about, all of us have talked about the immense potential that the country holds. For all of us in terms of growth, insurance sector, Amrit Kal, while making sure that you are developing products for people across the entire population. And India is an extremely diverse country. You have people across all strata of society, developing products for them, yet making sure that there are guardrails around the product. Also making sure that they're sustainable from an insurance company's point of view is not an easy challenge to address. I'm really, really happy to have Arora ji here with us, sharing some of the ideas that the regulator has. And over to you, Arora ji. Yes, yeah, please.
Very good morning to all of you. President of the Institute, Ms. Preeti Chandrashekhar, my friends from the actuarial profession from India and abroad, and industry participants. It gives me immense pleasure to be a part of this global conference of actuaries, the theme of which is actuarial excellence in the age of disruptions. So, we recognize that this is the age of disruptions. And these disruptions, particularly in the regulatory space, have kept all of you extremely busy in the last 3 years. And this is likely to be so in the near future also. And we also recognize that actuarial excellence is required to navigate these disruptions and reach the desired outcomes. When I say the desired outcomes, it means that as a result of these disruptions, the consumer journey, the customer journey in the entire insurance process is made comfortable. Consumer-friendly solutions are innovated, and there is a mass appeal to it. Costs are reduced, efficiency is improved, facilities are enhanced, benefits are increased, and the routine mindset and the routine processes are challenged. If I think in the recent past, in a decade or so, I can say, there have been many examples, I can give some, where disruptions have happened which have challenged the existing systems. You see, about 15 to 20 years ago, in India, the air travel was considered a luxury for most of us, for most of the population. Then there came a person who said that I will provide air travel at 500 rupees a seat, just 500, which is equivalent to $5-6. And that caught the imagination of most of the population. It is not that the entire flight was being offered at 500 rupees. It was just few seats per flight. But see the impact, how the air travel improved, how the facilities increased, how the number of air travels manifolded, number of airports increased, and it completely disrupted the market. See the example of Uber, how it has made the urban transportation more convenient, comfortable, as well as economical. See the example of Netflix, how it has completely transformed and changed DVD industry into online streaming. When we were in the younger days, I can think about myself, to withdraw money from a bank, we had to compulsorily visit a bank branch, take a token, wait for our turn, and take our own money from the bank, that too within the limited banking hours. Compare it with the situation which is prevalent today, how the integration of technology with the consumer services have helped the industry to grow and resulted in financial inclusion. Similarly, take the example of LIC premiums. The policyholders had to compulsorily visit the insurance company's office to deposit the premiums. And now they can deposit the premiums 24/7 from the comfort of their house using technology, and even without bothering about whether they have money in their account or not, they can pay the premiums. So this is the situation now. These are the example of disruptions. There are many, and these disruptions in different sectors of the society have helped the economy to grow, have helped the economy to grow at a faster pace. Now see, we take pride in saying that now we are the 5th largest economy in the world. 5th largest economy in the world. And very soon, in the next few years, we are going to become the 3rd largest economy in the world. And when we become the 3rd largest economy in the world, can it happen without the proper support of insurance? The existence of the insurance infrastructure has to propel that growth. And insurance infrastructure can do that with the support of reinsurance infrastructure. So these are all linked. These are all linked. So not only that we are the growing economies, fastest growing economy in the world, we are also one of the fastest growing insurance markets in the world. In financial year 23-24, the amount of premium written by Indian insurers, total amount of premium written, was around $130 billion. We are at number 10, and very soon we'll become at number 6. So whereas we are at number 10 at 130 billion, the China wrote 724 billion US dollar. US wrote at number 1 position 3 trillion of insurance premium. You see, this is the scope available, and consider the facilities, consider the advantages right now we have in the Indian insurance market. You see, more than 2/3 of the Indian population is young. This is a huge demographic dividend. Most of the persons are millennials. The digital payments, internet, have reached the remotest corners of the country. There is a rising middle class. There is a high level of disposable income. There is an increasing awareness about insurance, particularly term insurance, annuity products. So all these things point out to a fact that there is a huge potential and is waiting to be tapped, and there is a one minor disruption can think about wonders. You see, in 2014, one disruption happened in the banking sector. I can say it was a minor disruption when the government opened Jan Dhan accounts. The purpose was every individual should have a bank account. And it was successful. Everybody had a bank account. And few months after that, another disruption was planned, and it happened. That was Pradhan Mantri Jeevan Jyoti Bima Yojana. Most of you will know. Prime Minister's Jeevan Jyoti Bima Yojana. It's a low-cost risk cover protection product, and Pradhan Mantri Suraksha Bima Yojana. These two products were launched with a very low premium and some risk cover. And what was the USP of these products? There was no proposal form to be filled. Onboarding was easy. Premium payment was comparatively easy, only one SMS, and claim payment was seamless. Now see, in India, during 1 year, the entire set of life insurers sell about 3 crore policies, means 30 million policies. 3 crore policies in 1 year. This one product, Jeevan Jyoti Bima Yojana, in FY 23-24 had 11 crore policyholders. 11 crore policies were renewed in one product. And if I think about Jeevan Jyoti, that Suraksha Bima Yojana, Pradhan Mantri Suraksha Bima Yojana, there the number of policyholders is 33 crores, means 330 million. We talk about penetration. It's 3.7% of GDP. You see, out of this total population, 330 million in one product. 11 crores means 110 million. 110 million in another product. And one insurer, there are 26 life insurance companies in India at this point of time. One insurer got the premium of 1700 crores in this one product. 1700 crores about in FY 23-24. And there are number of life insurers where the total new business premium income is less than 1700 crores. See, one product can do such wonders. So you see, when the product is simple, without any options, and onboarding is easy, claim payment is easy, you can definitely reach the remotest corners of the country and insure everybody. And insure everybody. So this is the lesson from that. We still go on designing very complicated products with 20 options, sub-options. The more the number of options you have, the more bulky the policy bond will be. The more lengthy the customer information sheet will be. And nobody would like to read that. Have simple products. Target one area, one need, and you will see that product can be successful. And make that product affordable, accessible. All these two products which I have talked about, these are affordable and accessible. And earlier, there was some problems because premium was low. But now the premium has been increased. Solvency requirements have been reduced. And then still, there is a lot of scope to do much work in this area. Now, you see, these disruptions happened and helped in the penetration of insurance products. There are other disruptions which happened at the regulatory level. If I say, we have tried to make the ease of doing business and reduce the compliance burden. When I say this, we sometimes take pride in saying that in the last 3 years, we have repealed 167 circulars. Repealed 167 circulars. Whatever was there in those circulars no longer required to be complied with. Then another 210 circulars combined and modified into just 12 circulars. So you see, 377 conditions or circulars now merged into only 12 master circulars. Anybody who wants to understand the Indian insurance landscape earlier was required to go through all these 377 circulars, now just 12 master circulars, a major disruption. There were 78 regulations. Now there are only 26 regulations, and the work is still going on. So we have made the regulatory landscape much easier to understand, much easier to comply with. In addition to that, the regulations and regulator now is more accessible, more supportive. We are adopting a collaborative approach, consultative approach, so that the industry grows, and it has helped. You see, now there is ease of entry as well as ease of exit. When I say ease of entry, any new entrant wishing to come to the Indian market the compliance requirements are very low. There is an online NOC portal. There is a designated team in IRDAI which will handhold. And the conditions of change of status from promoter to investor, these conditions have been relaxed. And if the promoter or investor wants to dilute the stake to 26%, these conditions are also there and more relaxed. If you want to raise the capital, now all of you know, in the current budget, the FDI has been announced, 100% FDI. If you want to raise capital, other forms of capital, so many options are available. Limits have been doubled. Prior approvals are not required. So all these have helped the investors to come to India and set up their shops here. If you see, in the last 2 years, I can say now 8 new entities have started the operations. 3 new life insurers, 2 new standalone health insurer, 1 general insurer, 1 Lloyd syndicate, and last week 1 new reinsurer has been given license. And accepting this last one, all other new entities are comfortably writing the new business and contributing to the increase of insurance penetration in India. In addition to that, expense of management limits. These have been relaxed. You see, in general insurance, there is one limit, 30%. Within 30%, you do whatever you want to do. All the sub-limits have been removed. It's your operations, it's your business. You want to write health business, you want to write motor TP business, motor OD business, crop business, whatever you want to do, you do. Your expenses should be within 30%. If it's a health insurance, standalone health insurance company, the limit is 35%. All other sub-limits have been removed. If it's a life insurance, the monitoring or compliance is checked at the 2 broad levels, whether it's a par business or it's a non-par business. And there are benchmarks given for each year, for each line of business. You calculate the limits and see whether you are within the limits at the overall level or not. So all these flexibilities have been given to reduce the compliance burden and to make the insurance penetration and insurance reach more wider. Because if an insurer wants to reach the remotest corner of the country, the difficult terrains, difficult to reach areas, it is expected that he may be required to spend more to acquire the business, spend more to service the business. So he can allocate more expenses there. So there are no sub-limits available. So he can operate within 30%. So after having done this, now for the first time in the last year, we have refused forbearance on EOM regulations to some insurers. We are expecting the insurers who have given their glide path to be compliant with these limits, they have to follow the glide path. If they don't follow it, the regulatory action we are expecting now, the forbearance is a thing of past. This will not happen now. Now, if you see the actuarial part, you see, in the non-life sector, there are many insurers who are facing some difficulties. If the appointed actuary resigns or decides to leave the organization, then it was difficult. It was, I can say, a scary thing for the management to find a new competent person. Now, for the first time in actuarial regulations, we made a provision of consulting actuary for 6 months. You can have a consulting actuary. And after that, you can have an actuary with a mentor for 1 year. So all these conditions have helped the insurance companies to continue and get the actuarial support from the market. In addition, we have made it compulsory for the life insurers to have at least 2 more qualified actuaries in addition to the appointed actuary. For a non-life insurers to have at least 1 qualified actuary in addition to the appointed actuary. And the last date for the compliance of this regulation was 31st December 2024. And the intention has been, when for any reason the appointed actuary decides to leave the organization, there should be a second line available in that organization, in that company. The management should not face any difficulty. And as on date, most of the life insurers have followed this. There are some general insurers who have not just followed that or complied with that condition. My request to all those general insurers is that please comply with that condition. In addition to that, in corporate governance, in reinsurance, many changes have been done which will facilitate the growth of insurance business in India. Now, after having said this, there are some areas of concern which I would like to share with the actuaries, and I'm hopeful that when I say it is not pertaining to all the industry, there are only few here and there who are resorting to these things. The first thing I would like to talk about is the portfolio. You see, if I check the new insurance products which are being launched by the companies in the use and file regime, most of those companies, most of those products pertain to single premium or limited pay policies. The significant proportion of the total life insurance premium received in India pertains to the single premium mode. You receive the entire premium for the entire term in one go. Fine, there is a segment which needs this and it is okay. And then limited pay policies. The term of the policies ranges from 25 years to 30 years and 35 years. But the premium payment term is just 5 years, 6 years, or up to 10 years. So for a 30-year policy, you want to receive the entire premium in 6 years. In that situation, the first year premium is not justly the first year premium. It is equivalent to 6 years regular premium. Okay? Your intention, most of the companies, the management intention is to concentrate on the top line growth. And it helps in the top line growth. But what happens is, if year after year, you continue doing this business, what will your portfolio look like after 15 years? Have you ever projected? Your portfolio will have more than 75% policies which don't pay any premium. Not because these are lapsed policies, because they have already paid all the premiums in the first 5 years or in single premium. So can you imagine a company, can you imagine a family where all the members are non-earning? They only depend upon assets. And it can lead to serious liquidity problems, ALM issues. And I expect the appointed actuaries, when they present their valuation results to the board, they project, if you continue writing this business for the next 10 to 15 years, what will their portfolio look like? Are they agreeable to the situation where the entire renewal book dries up? If you see expense of management regulations, very important facilitation was given to the industry. I think most of the persons have not noticed it. Renewal premium limit. What was the earlier renewal premium limit? It was 15%. So you can spend up to 15% of the renewal premium income to service the policies. This was the limit, right? Now what is the limit? 17.5%. And in any life insurance company, a renewal book is expected to be very strong, much, much higher than the new business premium income. 2.5% increase. And if I look at the valuation report and experience analysis of all the life insurers, what is the actual experience of new business expenses? Sorry, renewal expenses? 0%. Many companies, because it is beyond 2 decimal places. Premium related renewal expenses are 0.00 some percent. The highest is 3%. So when you spend highest 3% of premium, renewal premium on renewal expenses, the regulator increases the limit by 2.5%. Isn't it fantastic? What is the intention? Intention is concentrate on persistency. But even then, 50% of the policies go out. Concentrate on regular premium policies. Even then, entire single premium or limited pay policies. So, if you truly concentrate on this aspect, there cannot be a single insurer which breaches the UM limits. It is not possible. This is one area. Second area, when I see the financial condition reports of general insurers, particularly motor TP, so various justifications are given. Most of the companies try to reduce the IBNR reserves. And the reason given is, now more technology is available. We are with certainty can say that this claim will go up to 2 years only or 3 years only. There is no need to keep these IBNR reserves, and experience is favorable or expected to be favorable. Okay, it's judgment of the appointed actuary. We agree to that. And we see next year what has actually happened. But when the same company CEO comes to us and say, sir, experience is very bad, please increase the TP premiums. So where is the inconsistency? Somewhere you say that loss ratios are good, the other person from the same company says, please increase the premiums. And motor TP premium is a mandated business. Policyholders are required by law to insure their vehicles. And when they are required by law to insure their vehicles, is there any need to remunerate the intermediaries to procure that business? Is there any need? The earlier regulations, when there were sub-limits, very negligible amount was allowed. even though it is a motor TP business, but the distributor or the intermediary spends something. There is some cost attached to it, so he should be compensated for that. But when in motor TP business, you want to pay high commission and then come to us, sir, please increase the premium rates. We are bleeding on this. So should we agree? We have to go by the data, na? What your data says. This was one issue. Then another. Recently, in one of the products, because more than 90% of the products are under use and file. In one of the products, launched by a company, which is a term assurance product. Now, what we understand by term assurance product, if the policyholder discontinues that policy, it's a pure protection product. There should not be any discontinuous benefit. There is no surrender value in term assurance products. But as I have said, most of the companies go for single premium products or limited pay policies where the policyholder has paid the future premiums. And if he surrenders the policy, so he is eligible for some refund. That was allowed. But if we launch a product which we say it's a term assurance product with high risk cover, and if you surrender that policy, I will return 200% of the premiums to you. As a regulator, I don't have any problem. It's your design. You want to pay 200%, 300%, 4 times, you pay. But I will question, how many policies in normal saving products you are paying double the premiums even on maturity? How many policies in other lines of business, even after payment of 15 years of premium, you are giving some IRR to the policyholders? And it's a term assurance product. Normally, it doesn't have a surrender value. And you want to pay double, you pay. But address that also. I am 100% sure, had the regulator mandated, you pay 200% in a term assurance product, entire industry would have been up in arms against the regulator. This is wrong. Now, since one person has done it, the entire industry, the marketing department will be sitting on the heads of appointed actuaries. He has done it, you also do it. And entire industry will replicate it. And then if we mandate, yes, this is what you are doing on your own will. Now, this is the norm in term assurance product. No, in saving products also, then what will happen? So whatever you do, please think about it. I'm not against this design. I have to study that design. If the policyholder is getting some benefit, let him get it. Fine, no problem. Then, recently, you might have seen, due to derivatives, there was a problem in one bank in India, right? Those of who are interested in investments on stock markets, the stock of that bank went down by more than 26% in a single day. Why? It was not a fraud. It was due to a derivative transaction where they were hedging their foreign currency deposits and liability using an interest rate swap. Right? The floating rate Indian equivalent was used to hedge the fixed rate foreign currency liabilities. Whereas one leg was mark to market and the other leg was at swap cost. One leg was hitting the profit and loss account and enhancing the net interest. The other leg was securing the balance sheet. It was going on. One day the regulator, RBI, said, you please review your derivative portfolio. And then it came to light. And when the positions were unwound, there is a huge reduction in net worth. And the stock went down by 26%. All through this, the accounts were audited, concurrent audit, statutory audit, everything was there. Okay. Now you compare it with the insurance industry. Most of you are selling the non-par policies, isn't it? Policyholders like the guarantees, you give the guarantees, fine, no problem. And in order to hedge that guarantees, you enter into forward rate agreements with few entities. If I see the total exposure or FRAs right now in the country is about 2.5 lakh crores. And 20% of that belongs to one company only, 50,000 crores. And even if there is a 5% unfavorable disruption, what will be the impact on net worth? 2,500 crore. What was the impact on IndusInd Bank net worth? 1,577 crores. So 1,577 crores reduce the share price to 26%, and if this thing happens here, what will happen? Okay, this is allowed, regulators allowed the derivatives, it's your appetite, your risk appetite, you are giving guarantees to the policyholders, you are hedging that cost, fine with us. But my only point is, be careful about the entire transaction. Mark to market, whether it is hitting the solvency, whether you are taking advantage of any NPM gains, it is not allowed. And then, to hedge the guarantees is fine. To hedge the guarantees is fine. But this cannot be used as a tool to reduce the reserves. In fact, we are getting more risk. You cannot say, now my interest rate is fixed, and I have guaranteed that, I have FRA into that, there is no need to any margin, for any margin in the reserves. And if this is being done, so my request to the profession is to discuss amongst the actuaries and have actuarial practice standard on this aspect. This is required. In addition to that, one or two issues which I require the Indian Institute as well as the UK Institute to please consider. We are interested in numbers. Numbers should increase. Actuarial profession will increase, but not at the cost of quality. Though it is up to you how you conduct the examinations, in which format you conduct the examinations, whether it is objective type, whether it is descriptive, what standards you fix for the exam papers, what standards you fix for the passing, but please see that quality is not compromised. When we are asking about actuarial excellence, that excellence is to be maintained. And it should not happen that the people start losing faith, seeing that, okay, if he can pass, I can also pass, something like that. So please be careful about that. We need to do something about that. Now, before I conclude, something about the risk-based capital. See, an interesting thing happened in the recent past. Due to these developments, the US equity went down by how much? 4 trillion. 4 trillion. What is the size of Indian economy? Less than 4 trillion. The total market went down by 4 trillion. And if we see our solvency requirements, there is no charge on assets. Though it is allowed, we have made it 0. No charge on equity investment, no charge on property investment. It's only factor based on liabilities. Right? So now, right now, we are moving towards risk-based capital. And here, I must appreciate the good work done by most of the actuaries, by all the appointed actuaries, because when we asked the appointed actuaries to submit the data in QS1, it was not an easy thing. Prior to that, there was only reports. There was nothing which the actuaries did to see the impact. For the first time, the impact was seen. A detailed template was provided to the actuaries, and it required the entire information of the assets, liabilities, market value, best estimate, recalculation of liabilities, and filling in the information in different parts of that template. It was a very huge task. And my appreciation to all the companies that most of them submitted the results within the time frame, and only 1 or 2 were there. They also submitted immediately. And we went through the results. We found there have been many interpretation issues. There have been many mistakes also, but we engaged one-to-one discussions with all those insurers, and they resubmitted. And after resubmission, we have analyzed the results. And these results have been presented to the entire industry, the CEOs as well as the appointed actuaries, in a meeting held by the regulator in the month of November. I see from the agenda that yesterday there was a panel discussion on risk-based capital, and I hope the useful discussions might have taken place there also. But some of things which we have noticed from the results are that, as expected, I speak about life insurers first, the amount of assets have grown, and it was expected, because right now we are on book value basis, and risk-based capital means market value basis. So amount of assets have increased, and the increase in the amount of assets in life insurers is 8%. Liabilities have reduced by 4%, because liabilities are calculated or estimated on prudent basis, and risk-based capital required best estimate basis. So there is a 4% reduction in the liabilities, with the result that the available solvency margin increased. Right. Now, available solvency margin increased. Now, there was a turn to calculate the RSM, required solvency margin. Now, since we are on risk-based, depending upon the risk of each company, as well as the assets are also now considered for calculation of the capital requirement, the RSM increased by 2.5 times. So there is increase in available solvency margin. There is increase in RSM also by 2.5 times, with the result that the solvency ratio of most of the insurers have come down slightly by few basis points. But barring one or two, all the life insurers are above the control level of solvency, as far as the life insurers are concerned. If I see the non-life insurers, their assets increased by 29%. Good increase in the assets. But surprisingly, their liabilities also increased by 14%. So I was expecting, if they are calculating the liabilities on a prudent basis, when we move to risk-based capital, there should be a reduction in the liabilities. But instead, there is an increase in the liability by 14%, right? And then we have tried to find out the reasons, and there are, because there are some factors which are higher, there are some factors which are volume-based, so liabilities have increased, accepted. But since the increase in assets is 29%, increase in liabilities is 14%, still there is an increase in available solvency margin. But when I see the required solvency margin, RSM, that has increased by 2.9 times, with the result that most of the non-life insurers have seen a significant dip in their solvency ratio in the QoS1 results. Right. Similar is the situation with the reinsurers. Now, we have discussed these results, and all the insurers have given us some suggestions, and some of the suggestions include, you please remove the cap. We have put a diversification cap, benefit cap at 30%. They have said, you please remove these caps. And there are some factors like premium and reserve factors, and property and equity factors, mortality and longevity factors. They have asked us to reduce those factors. There are some floors. For example, in non-life, the premium liabilities are floored at UPR. The life insurance liabilities are floored at SSV or asset share at 0. So the industry has requested us to remove those floors. And in non-life, the first year discounting is not allowed. And they have requested us to reduce, to remove that and allow the discounting in the first year also. And for life insurers in participating business, they have requested us to allow the future shareholder transfers from par business. These are some of the suggestions. And we are considering, some of the suggestions may be considered in QoS2. Very soon, we will be coming out with QoS2. For that purpose, we had formed 3 working groups. One working group was looking at the market risk and operational risk. Another working group was looking at the life insurance risk and operational risk. And third, non-life insurance risk and operational risk. 2 working groups submitted their reports long back, and one working group has submitted the report just few days back, and that is non-life insurance risk and operational risk. And as I understand, it's a very detailed report. They have considered so many scenarios running into hundreds of pages, and then I think in other jurisdictions also, so many factors have not been considered. And these calibrations have been done taking the Indian data, Indian factors into account, and definitely while coming out with QoS2, we will be using that data. So with these words, I would like to conclude, and I'm sure that the actuarial excellence which we have depicted in the past and which we will depict in the future, no matter whatever the disruption, we will be able to achieve our vision, which is the insurance for all by 2047. Let us contribute towards Bima Krit Bharat, Viksit Bharat, Samriddh Bharat. Dhanyavad.
You would all agree that the passion was evident in what he spoke? And I was not wrong. I knew him from more than 30 years, and it continues. The passion continues. Thanks a lot.